Okay, let's take a moment, look at the disclaimer. This content is for educational, information, entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We're here just to tell you how BTA look at the market, how we analyze the markets. This is Rod from BTA, and we are known as the middle traders. We are not going to get in at the exact bottom. We are not going to get out at the exact top, but we will. We are going to eat, make that money in the middle. Okay, this is part two of our weekly walk with the market. You already know we got to walk with the market. We got to stay in step with the market. We got to stay in tune with the market. We don't want to go behind it because we'll be too late. Then we watching that news stuff. By the time you hear about it on the news, it's too late. You don't want to go before it because you want the market to prove itself. You might get out there too far in front, start sprinting to that pile of money you see, get tired and run out of gas. You don't want that to happen. So you want to walk with it, be right on time with it, stay in step with it. Okay, this is part two. What we're going to look at here is our weekly Fibonacci levels for the major market indexes itself. All right, just for a little refresher with the Fibonacci levels, it's just a tool that'll tell you how much an individual security has retraced or given back of the move that it made, depending on where you set it at. Well, I set it from the March 2020 lows to over here, the November highs. Okay, the November highs. That's where I set it at. Okay, from the low to the high. And then it'll give you some levels. And as it pulled back, it'll tell you what level it has retraced. That's why this is called the Fibonacci Retracement. It'll tell you how much the move has retraced, how much is it giving back. You got the 23.6 level, the 38, and you got the 50% level here, which is the 50% retracement level. Don't forget the 50% retracement rule that'll make you rich, baby. It's a golden rule. 50% retracement level. Then you got the 61.8 and you got the 76.4. When you start getting inside here, that's what we call the golden pocket. That's the golden pocket. You come down there, you should get some resistance, some support and bounce. Same thing if you're running up and you get into the golden pocket between the 61.8 and the 76.4. That should be the area where you see your resistance and the continued boom. It collapse. Well, that's the golden pocket, baby. The golden pocket. So this is the Dow Jones Industrial Average, the actual index itself. We got our Fibonacci retracement going from the March 2020 lows going up to the highs in November. Okay. And right now the Dow Jones Industrial Average came back down and it retraced exactly almost to the penny to the 38.2 level. That's that goldish looking line. You probably can't see it too well. Let me see if I can zoom in and let me see if I can expand it a little bit and then try to zoom in and see if you can see it a little better. I'm not sure if you can, but this little golden line right above this big thick red line you see right here, that big thick red line. You see that big, thick red line, don't you? That big, thick red line. Okay? I don't have to tell you what that big, thick red line is. You heard me say it enough. That's the high. That's the high of March 2020, right before the corona collapse. That big, thick red line right there. All right? So going back to the Fibonacci retracement, zooming in, well, we retraced the move right down to the 38, okay, the 38.2 retracement level, and then we bounced last week, okay? So we traded right down to that fib number, okay? Right to that 38, and we traded right down to that big, thick red line right there, and then we bounced. Let's see if it can hold support and keep moving. The next level is this 23 level up here as resistance on the fib, 23.6 level. That's right around 32,530. We had 31,500. 32,530. You're talking about another 1,000-point move for the Dow Jones. And then we're going to be testing the resistance at the 23.6 retracement level. Let's see what happens. Let's look at the Standard & Poor's 500. The Standard & Poor's 500 pulled back. We did the same thing. We put the Fibonacci retracement from the March 2020 lows to the highs back in November. Okay, and we have now given back and retraced back down to the 38.2 level also. Got below it just a little bit. Didn't make it to the 50% level. Got below it just a little bit. And then we bounced and got back above the 38.2 level, okay, last week. All right, we got back above it. This 38.2 level, 38.2% level of this Fibonacci retracement is actually right around the 3,800 level, the price around 3,800. We had 3,911. This 38.2 level is 38.14 on the Standard & Poor's, okay? So we traded down right below 3,800, and then we found support, and we moved back up, and we got back above this fractal right here, which is right around 3,800, and we got back above the 38.2 Fibonacci retracement. Let's see if we can move back up to the 23.6 level, and that'll be right around 4,198. So you might as well say the 4,200 level. Okay, let's see what happens. Hey, we get back there, we might go back to those highs of the inverted yield curve date and do what it has always done in the past. And then don't forget, after that, history has says we get the inverted yield curve, then we run back up, peak, at least get to the high of the inverted yield curve date, might make all-time highs. And then job losses, bubble pop, 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 market drop, recession. Inverted yield curve, trade off, rally back up to the highs of the inverted yield curve date, job losses, recession, market pop, 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 bubble pop, market drop. Here's the Nasdaq Composite, the actual index itself. Same Fibonacci, same levels we put the Fibonacci on. Guess what? We came right down, traded just below the 50% retracement rule that'll make you rich, baby. And now we back above the 50% retracement level at 11,421 at the 50% retracement level. We're at 11,607. Can we hold this support and run back up to the 38.2 retracement level, which is at 12,552? Can we hold support and can we stay above? We traded below the 50% retracement right here, and we got down, almost down to the 61.8, but not quite there. I thought we were going to get into the golden pocket, start testing these big, thick red line right here. You see that big, thick red line? Do you see that big, thick red line? March 2020 highs right before the corona collapse. Somebody say you see a big, thick red line. First thing you're going to think about is those March 2020 highs. Trust me. Okay? That's inside the golden pocket, though. We didn't make it to 61. We didn't make it in the golden pocket. We got right below the 50% retracement rule, made a lower low. Now we got back above 50% retracement. Can we find support, bounce up, and go to the 38.2, which is right around 12,552? Let's see what happens. Let's look at the IWM. Let's check out the small guy and girl. What are they doing? You know, they try to make it hard on us small people. Well, here it is. We came back to the 50% retracement rule, right? The 50% retracement level, which is our 50% retracement rule that'll make you rich, baby. We traded back down. We got right down to the 50% retracement level, and we traded below it just a little bit, and we jumped. A market, securities have a habit of coming to the 50% retracement, consolidating and bouncing. That's why they call the 50% retracement rule that'll make you rich, because they got a habit of hitting the 50% retracement rule and bouncing. Well, we traded below it just a little bit, and now we got back above it. Can we come back, hold support? And what's that big, thick red line right there? You see that big, thick red line right there? That big, thick red line right there? March 2020 highs right before the corona collapse. We was able to get back above it last week, okay? We was able to get back above it last week. Can we go now back to the 38.2 level, which is $187, okay? Which would be $187. The price would be $187 on the IWM. We closed this week. We got right back above the 50% retracement level, right back above the March 2020 highs. We closed last week at 175.09. Can we get back up to these here fractals right here? Okay, which notice that. You see what I'm trying to tell y'all? You think I'm not a computer programmer, but those algorithms see what we see. Trust me. Or do we see what they see? Well, you see, we put the Fibonacci retracements on here. We didn't create where the 38.2 level was going to hit. And isn't it quite interesting that we put our Fib retracement level from the 2020 lows to the November highs? The computer formulated the levels. And guess what happened? It's right on these two fractals to the T. I couldn't make that up, y'all. I cannot make that up, that this Fibonacci retracement level is drawn here. Prices started trading down, and it stopped right on the 38.2 level twice. Computer algorithms at its best. But we see you. You can't fool us. We're on to you. Okay, can we get back up to the 38.2, which acted as support? This time it might act as resistance. It's done it once. Is it going to do it again and get rejected? Or are we going to bust through, baby, and get back into this consolidation area and start testing the 23 area, 23.6 retracement level, get back to them highs of the dated inverted yield curve? Never know. Okay, let's look at our percentage of stocks that's above. The percentage of stocks that's above its 200-day moving average for the entire U.S. market is only 13%, y'all. Only 13% of stocks is above its 200-day moving average for the entire U.S. market. See how it's been consolidating sideways here for the last couple of days, last couple of weeks. It's only at 13%. Only 13% of the total U.S. market is above its 200-day moving average. There's no need to fear. This is not financial advice. But wouldn't it be wonderful if it was? Wouldn't it be great if it was? But it's not. But if it was, cha-ching, cha-ching, ching, ching. Or at least you would not lose too much money. But it's not. But FOMO, fear of missing out on anything, what are you fearing? There's over 10,000 tradable, what we consider tradable stocks in the U.S., the total U.S. market. Only 13% of them is above their 200-day moving average. It's a whole lot of them got a whole lot of things to do. So money can be made. It ain't over yet. Now, look at the total U.S. market, the percentage of stocks above its 50-day moving average. Now, you know if it ain't above its 50-day moving average, you ain't got no real power trend or nothing going on. It's only 23% of the stocks. Only 23% of over 10,000 stocks is above its 50-day moving average for the total U.S. market. Come on, y'all. There's no need to fear. It's plenty time. Plenty time, as far as we're concerned. Now, this is the Standard & Poor's 500. The percentage of stocks, let's do the 50 first. The percentage of stocks that's above its 50-day moving average in the Standard & Poor's 500. It's 500 stocks in the Standard & Poor's 500, right? only 21% of the stocks is above its 50-day. If you ain't above the 50-day moving average, you know there ain't no real power going on there. Ain't no real strong uptrend happening. You can't even get above the 50-day. Only 20% is above the 50-day, y'all, out of 500 stocks. It's a whole lot of stocks that got to move. And when you look at this percentage of stocks above its 200-day for the Standard & Poor's 500, it's still only 20% above its 200-day. You know what Paul Tudor Jones say. You know what Paul Tudor Jones say. If a stock is above its 200-day moving average, I'm going long and not short. If a stock is below its 200-day moving average, I'm shorting and not going long, or I'm sitting on the sideline. The 200-day moving average is the line in the sand. That's what Paul Tudor Jones said. I believe in Paul Tudor Jones. Okay? You know what he's talking about. Made the money to prove it. Okay, let's look at the Nasdaq Composite. The Nasdaq Composite actually, as far as the percentage of stocks above its 200-day moving average, its 50-day, which we're going to look at first, got more than the rest of the major market indexes. It got 29.9, say 30%. Still under the red line, which is a 40% level. You know when the percentage of stocks below is 50, above is 50-day, percentage of stocks above is 50-day. When they get below 40%, that's the red light, baby. The red light. You got trouble. Slam the brakes. It might be trouble or ruin. Okay? So slam the brakes. You start getting below 40%. The percentage of stocks above is 50-day. We get below 40%. Well, it's starting to be a problem. You might go into a correction, a downturn, and maybe a bear market like we got now. Well, we at only 30%. We still well below the 40. It's looking a little better than the total U.S. market and the Standard & Poor's, but still pretty bad. No need to fear. It's a whole lot of time. And when you look at the percentage of stocks above its 200-day moving average for the Nasdaq, man, it's only 13% of the Nasdaq above its 200-day moving average. It's over 3,000 stocks in the Nasdaq. And the people in the news talking about market rallying, and all this other garbage get you all worked up. Market rallying, hitting highs. And, is it too late to get in? Man, don't make me curse. What the heck you talking about? Too late to get in. And only 13% of the Nasdaq is above its 200-day moving average. If this is a rally, come on, man. Cut it out. If this is a rally, you got a whole lot of stocks that got to do a whole lot of stuff to make me a whole lot of money. Okay? Come on, cut it out. All right. Let's look at something right here that is very interesting. And we're going to go straight to the NASDAQ. Okay? This is a chart, daily chart. The histogram marks each histogram bar is a day. Up top, you got the number of stocks hitting 52-week highs. And this is for the Nasdaq Composite itself. And down here, you got the number of stocks hitting 52-week lows. Okay? Well, we still had 144 stocks hitting 52-week lows on Friday. And we had a banger of an up day, over 3%, and a follow-through day. And you still got stocks hitting 52-week lows. And you almost got 5% of the NASDAQ still hitting the 52-week lows on Friday. Because remember, that little crayon line represents the 5% level. Okay, 5% of the NASDAQ, which is 3,000 stocks in the NASDAQ. So 5% is right around 150, right? Well, we had 144 stocks hit 52-week lows. Well, we nowhere near the 5% crayon line up here. You don't even see it. It's way up top at 150. We only had 34 stocks hitting 52-week highs on Friday. So the number of stocks hitting 52-week lows did come down. Look how high it was before. It did come down. That's very positive. But we're still seeing some. But the fact that they're coming down and getting below the crayon line, less than 5%, that's wonderful. Well, you see the accumulation distribution line for the NASDAQ is straight down. It fell off a cliff. Okay? So that is what it is. All right. But let's look at our go-to baby market breadth indicator. Our go-to. Man, we watch this thing like we do our follow-through days. This is our go-to market breadth indicator. It's the advancing minus the declining differential invisible chart. We the only ones out there with this one. Nobody else got it. Do you hear what I'm saying to you? Do you feel me? Nobody else uses this. You know why nobody else uses it? Because we created it. Just like Lois. Proprietary data. Okay? Advanced decline differential chart. Y'all know I like to have some fun, right? So this is the advanced minus decline differential chart, the invisible chart. Okay, the data's in the background, we don't see it. These are moving average lines. We got the 9-day moving average, okay, which is the green line. We got the red, which is the 50, and the yellow, which is the 21. When the green line gets above the yellow and the red, when it gets above the yellow and the red, okay, and the green line gets above 0, okay, green line gets above 0, that's when we are starting to see a lot of good breath, very good breath coming into the market. And then soon we're going to get that little green arrow that's going to tell us it's safe to start buying. It's kind of like our follow through day. So when we get a follow through day, we definitely want to see the green line getting above the yellow and the red and getting above this 0 line, which is right here. Well, right now we see the green getting above the yellow and the red, and it's above 0. So we'll get the little green arrow probably come Monday, unless it totally collapses after Monday, right? And then we want to see the yellow and the red get above 0 also and start turning up. You see I got here the best signals. It's when the 21-day, which is the yellow line, and the 50-day, which is the red line, is both trending up. Well, right now they're turning up. Okay, so we just want to see them get above 0. But the green line is above 0 and it's above the red and the yellow. All right, the best is when it's turning up and they also get above 0. But that little green arrow will generate on Monday as long as that green line stay above 0. So that's for the Dow Jones. It's looking great. Okay, so that's telling us that we got some breath coming in. More advancing stocks than declining is starting to come in. So this is for the Standard & Poor's 500, the same invisible chart, advancing minus declining differential invisible chart, our go-to chart, baby. You see that green line got above the yellow and the red, and it's above 0, and the yellow and the red is turning up for the Standard & Poor's 500. Okay, we got our follow through day on Friday. You can see the power came in. So we got advancing stocks, outperforming declining stocks. We got some breath coming in there. All right. And you see probably on Monday, we're going to get this little green arrow generated. It's a go, baby. It's a go, go, go. But we ain't going to go too fast. You know how we do. We pyramid into the position. We build a position. Go in slowly. As the market proves itself, we add to our positions. All right. There. Now look at the Nasdaq. The Nasdaq, same thing. The green line is above the red and the yellow, and the green line is above the 0 line, which is this horizontal red line right here, the 0 line. And now the green and the yellow is above the 0 line for the Nasdaq, and the red line is turning up. So we will get a green arrow here for the Nasdaq come Monday, telling us it's a go, baby. Okay. So this is confirming our follow through day. This is confirming our follow through day. The Nasdaq is the only one where you have the green and one of the other lines above 0. If you notice, the Dow Jones is only the green line breaking above the 0 level. Okay, the red horizontal line. Only the green line breaking above it on the Dow Jones. Only the green line is above it on the Standard & Poor's. The other two are very close. But on the Nasdaq, you got the green and the yellow. The 9 and the 21-day average is above the 0 line. And the red line is turning up, which is the 50. That's even better. Okay, so we got that breath coming in, okay? We got that momentum coming in on the breath indicator. This is telling us the momentum of that breath indications, all right? You can see it. Now, look, let's look at our major market swing signal, okay? We put it up every morning on browntradingacademy.com on the website. You see on the 23rd, on Thursday, okay, on the 23rd, you see the Dow Jones started turning bullish, the Standard & Poor's started turning bullish, the Nasdaq was very bullish, and all the top holders in all the big major market index, all the ETFs and the sector ETFs was also very bullish. So we went from bearish to very bullish. Well, we went from bearish to, after we went from bearish, we went to, if you notice right here, on the 21st was all bearish. And then we went to bullish. The next day we was bullish again. And then you see it on the 23rd, which was Thursday, it was too bullish and it started turning very bullish for the Nasdaq. You see that? And then look what happened. This is Friday. I'll be posting it later on today or first thing in the morning, but I'll give you a glimpse at it. This is Friday. Every turn turned very bullish. You see how a major market swing signal, this is lowest. This is lowest, tracking all of the stocks that's in these here, Dow Jones, Standard & Poor's, Nasdaq 100, and all the top index holdings, okay, which is about 180 stocks. This is lowest, tracking them, telling us are we in a bullish upswing or a downswing. The percentage of stocks. She tells us the percentage of stocks that's in a bullish upswing. This is lowest. Look how lowest was telling us bearish. And then she started improving, bullish, improving to bullish. It's through to bullish and then very bullish. And now she's saying very bullish. You see what's happening? We can't lose with the stuff lowest use. So we don't only use lowest to tell us when the actual stock is in a upswing or downswing. We also use lowest to give us an indication of the breadth, what percentage of stocks that are actually in that swing. We can't lose, baby, with the stuff lowest use. This is part 2 of walking with the market. You see how we get that ching ching? Because we walking with it and we watching everything moving. Now, look, it's going to be a part 3 that's going to be very fast. I'm going to stop this one here and make it a part 3. Going to be very fast to this because on part 3, okay, it's something I got to show you. We're starting to see improvement. And our other little smaller breath indicator, I got a whole bunch of breath indicators I look at. I can't show y'all all of them. I keep you here for 4 hours. I'll be putting that work in, okay? But I want to show you this breath indications. We got 4 quick charts to look at for the third part, and it's telling you more volume, looking at more volume. We got 4 charts in the third part, and then we got some volume analysis that we haven't seen yet. We want to watch that volume, baby. So watch out for part 3. It's going to be volume analysis all day, baby. All right, this is part 2, walking with the market. Part 3, walking with the market coming. Don't miss it. I'm trying to show you something. I'm dropping them jewels. Are you picking them up? See you in the next video.